Welcome to this CNBC Africa special. I'm Chris Bishop. Now, within the next 3 hours, South Africa will know how big the next cut in interest rates will be. In the face of COVID-19, the South African Reserve Bank is expected to cut maybe up to as much as 100 basis points to try to ease pressure on the economy and also debt. But what good is it going to do? How likely are we going to see other measures like the Reserve Bank being instructed to buy bonds or even resort to quantitative easing? That's printing money in English. The prospect of the lowest interest rates for more than half a century is on the cards. And joining me to unpack more of this is Arthur Kamp, Chief Economist at Sanlam Investments. To start off with, Arthur, what's your prediction for the 3 o'clock announcement?
Good afternoon, Chris. Well, my hope is 100 basis points. My expectation is 50. I think one can build an argument for a 100 basis point interest rate cut simply because of the dire situation the economy finds itself in. Any reasonable forecast at this point is indicating a very steep contraction in GDP. People are not surprised when one talks about minus 8%, minus 10% real. So GDP in current prices even is going to contract. And if that's the case, one would also expect at the same time credit extension is going to be exceptionally weak. In fact, will probably contract as well. So when you have such a very large output gap and the prospect that inflation in the near term is going to probably slow further, I mean, global inflation is very low, that very large output gap that we have because of the weak economy, low oil prices. So when you take all those factors into account, they would argue for a negative real interest rate, probably a deep negative real interest rate. So if we look over the next year and we say, well, inflation is going to average, let's say, 3.5% or lower, then the repo rate, one would argue, should be lower than that. And so that's how we build an argument for 100. But the bank, of course, there are other considerations that one must take into account. And I think the two most important are, firstly, the bank is forward-looking, and its inflation forecast for next year in April was 4.5% average. Next year, it was even as high as 4.9 in the second quarter. So it may lower those forecasts, but nonetheless significantly up next year. And secondly, obviously, it will have one eye on fiscal policy. The unfortunate thing about continuous downgrades and currency weakness is that you get higher real interest rates. Bad things happen to economies when fiscal policy goes in the wrong direction, and unfortunately, one of those things is higher real rates. So if we look at the yield curve and you look at the long-term interest rates, which one could argue are investors' forecast for the future course of short-term rates, then these factors make it difficult for the bank to become too aggressive. So in a nutshell, that's why I'm hoping for 100, but expecting 50.
And also, Lesetja Kganyago, he's got a very sort of difficult balancing act in some ways. I mean, setting interest rates good enough to attract foreign capital, but at the same time, trying to give some relief to the mounting pile of debt in South Africa.
Yes, so that's definitely a balancing act. And with the currency weakness, we've seen the rand recover a little bit now, but essentially the currency has been weak for a sustained period of time, and the usual instrument that one uses to help stabilize the currency is not available at this point, and that instrument is hike interest rates. Clearly, with the economic situation that we have, it's not feasible to do that. So attracting foreign capital, one could argue that, yes, our bond yields in real terms are now very high, and if global sentiment were to improve, then perhaps foreign investors might be more interested. But nonetheless, we don't have the option of raising rates. And then if one looks at getting the economy going, yes, in this environment with real GDP where it's going to be economic activity, the risk is liquidations and insolvencies. The bank has done the right thing. They've eased banking regulations, they've supplied a lot of liquidity to banks, and they've cut the interest rate, and they'll probably cut it further. The problem is you could find that the bank is pushing on a string in this environment, because if you're a borrower or a lender, your problem is that your future income stream is not very clear. You're certainly not very confident about the future. So a lack of confidence and that lack of clarity about when the economy will recover, and if it recovers, what would it look like? What would the permanent income loss look like? And then would look like? And in that environment, it's very difficult to lend someone money or even to be confident enough to go borrow money. So the bank could be pushing on a string here. And so, yes, it has argued that the easing of bank regulations could produce up to 300 billion rand or more additional lending. But it's difficult to see in this environment. I must say, however, that's where the government has boxed very clever, and that's in terms of that guaranteed loan facility, potentially up to 200 billion rand for firms up to who earn up to around 300 million rand in turnover, so mainly small and medium enterprises. That guaranteed loan facility could help address some of this problem and give banks more confidence to lend. So I thought that was an important intervention in this environment.
But one of my fears still is, despite all of these measures, I think the economy, shall we be honest, is so crushed at the moment that surely it's going to take a little bit more than tinkering with the interest rates to try to revive it.
Chris, no question. So the government's package, the COVID package, if one goes through all the measures, essentially what we're not doing here is we're not stimulating new activity or creating new jobs. What we're trying to do is limit the downside and limit the extent of the fallout. You're quite right, the fallout is extensive. And in that case, the best one can hope for is to limit that downside. And that does bring into the picture potentially extraordinary policies. And of course, one of those potential extraordinary policies is quasi-fiscal policy, given the constraints that you have on fiscal policy itself.
And what other measures do you think might also be brought into play? Do you think the bank is likely to be instructed to buy more bonds? Could there be quantitative easing, as I said in the intro, in English, printing of more money, which could cause long-term damage?
Yes, I think there's an important distinction between the bank borrowing in the primary market and the secondary market. If it's borrowing in the primary market and directly funding government that way, then that is usually often seen as problematic and a very short step to much higher inflation. The bank legislation does preclude the bank from becoming heavily involved in that market. But of course, what we're talking about is potential borrowing in the secondary market. Now, yes, developed market economies they've gone on the route of extensive quantitative easing. We've even seen some emerging markets looking at this and beginning to implement policies and buying different types of assets that one could view as quantitative easing as well. We've seen it in Latin America, we've seen it in Eastern Europe. The question here then is, why is it more difficult for an emerging market to do it? I guess one of the arguments is that by definition, emerging markets are more risky and therefore should show higher real returns than developed markets. But one must also bear in mind that you could get to the point where the fallout in the economy is so severe and liquidations and insolvencies start to threaten financial systemic risk, then in that environment, the mandate of the bank starts to shift from a strong focus on inflation towards perhaps systemic stability of the financial system. And then the argument becomes somewhat stronger for a quantitative easing program. But before we get there, you'll probably find that the bank would continue to cut interest rates further. It's not close to the zero bound yet. And secondly, if one were to go the route of QE, so one of the problems that we have in South Africa is that government is borrowing at a very high real interest rate. New debt that it's issuing at significantly higher real interest rates than one would like, given the real growth rate expectation in the economy. What that means is that government can't stabilize its debt without a very sharp swing into positive territory in the primary budget balance. The primary budget balance just being revenue versus non-interest spending. If expectation is that could be bigger than minus 7% of GDP this year, and it will have to swing it into significant positive territory just to stabilize the debt ratio. That doesn't seem plausible given the demands that we're going to be seeing on government and over the next few years as the fallout of this COVID-19 becomes even more evident. And if that's the case, then what's the solution? The solution is lower real interest rates or grow the economy faster. And if real rates are seen as too high to achieve that, and that the market is not functioning properly, the argument for QE does become stronger. I would caution two things. First, if you were to go that route, you need to get the bank's buy-in. So the bank needs to be on board, because the African Reserve Bank, its primary objective is to maintain a sustainably low inflation rate in the interest of long-term growth. If it were not to buy in, that would be a signal that it doesn't believe that it can continue to do that if it went the QE route. And secondly, also very important, you would need to get the buy-in of the bond investors community. Bond investors know that historically the great inflation episodes, the bad inflation episodes through history around the world have come from bad times and fiscal failure. And if bond investors suspect that, well, all this is going to do is fund the government by the back door and allow the government to continue spending without recourse to eventually stabilizing fiscal policy and ensuring that the budget surpluses are eventually run so that bondholders are paid back. If bondholders were to suspect that's the case, then they would dump bonds in cash. And of course, that would be highly problematic. So I think the debate around this is going to heat up. I think it's something to consider, but all those conditions I've mentioned would need to be in place.
Thank you very much indeed. That is Arthur Kamp, a chief economist at Sanlam Investments. And I'm afraid that's all we've got time for on this CNBC Africa special, ahead of the MPC interest rate decision in Pretoria this afternoon by Reserve Bank Governor Lesetja Kganyago. We'll, of course, be covering that live right here on CNBC Africa. From me, Chris Bishop, and the team, it's goodbye.